Hey y'all, what's up? Your girl is back with another video. Today I'm repping my alma mater, Stony Brook University. Shout out to all my Seawolves. Woo! All right, so today we have an interesting topic. We're going to be talking about private mortgage insurance. And this was important to me because I recently got PMI removed from my mortgage. So as a result, my monthly premium went down. Thankfully, I have to give props to the person who I learned about removing PMI with, which is MG, the mortgage guy. You can follow him on Instagram or YouTube. He has a lot of great information on his channel. Okay. So that's how I learned that I was able to do this. And of course, I'm an action taker. So I went ahead and did it for myself. So I'm going to talk to you guys today about how I was able to do that and what kind of steps I had to go through in order to get it done. All right, can't wait. So, what is private mortgage insurance? Private mortgage insurance is a type of insurance that is often required for borrowers that have a conventional loan. It protects the lender in the event that the borrower, such as myself, would stop making payments on the loan and if I were ever to go into foreclosure. So, this is often required if you make a down payment less than 20% on that home. Okay, so that's the need. That's the reason why they have private mortgage insurance. So let me give you an example. If you purchase a home for $200,000, in order to avoid the PMI, you would need to make a down payment of 20%. So that'll be about $40,000. But if your down payment is less than that $40,000, that's when PMI comes into play. Okay. And the PMI, that private mortgage insurance, is going to protect the lender. Now, PMI is typically only required for conventional loans. Other types of loans, such as FHA loan, they have their own types of insurance and they're called differently, but typically, again, they're supposed to protect the lender. Now, I don't want to confuse private mortgage insurance with homeowners insurance because they serve two different causes. So whereas homeowners insurance protects the property in case that there's a damage to the property, your private mortgage insurance again will protect your lender in the event that you default on the loan. Now you might be wondering, what is a conventional loan? A conventional loan is a loan that is not guaranteed or insured by the federal government. For example, FHA, Federal Housing Administration, or VA, Veterans Affairs, something like that. Okay. That is what a conventional loan is. And to qualify for a conventional loan, the requirements are a little bit different. Typically, you have to have a higher credit score. You have to have a higher down payment. So as opposed to an FHA loan where the down payment is only 3 to 3.5%. For a conventional loan, it's typically 5% or more. With a conventional loan, it can also finance primary residence, investment properties, vacation homes. With an FHA loan, typically is only just your primary residence, and conventional loans are not backed by the government. PMI is typically based on the rates of insurance, but anywhere between 0.1 to 2% of your loan amount. And what they'll do is they'll give you the total amount of the insurance, and they'll split it up into 12 monthly payments on top of your mortgage to make it more affordable. Now, your lender will look at a few different factors in determining how much PMI you will make. And one of this is your down payment. So if you make a lower down payment on the cost of your home, the lender might look at this as a risk because your mortgage will be higher. Of course, if you make a lower down payment, your mortgage will be higher, right? So they look at this as a risk. It'll take longer for your PMI to be removed. So then they might charge you a little bit higher. Okay. So even if you can't afford a 20% down payment to completely remove the PMI, even increasing your down payment by a slight bit can help lower your PMI. They also consider your credit score. Okay. So if you have a higher credit score, of course, they will look at that you are responsible, you make your payments on time, and you don't have any bad collection. The type of loan that you have can also determine what or how much PMI you would have to make. So, for example, if you have a fixed rate loan, then you would typically pay a lower PMI than if you had an adjustable rate mortgage where depending on the month, your mortgage amount might be up and down. Of course, that is a greater risk because if you have an adjustable rate mortgage, then your lender looking at this that your mortgage can be high and then you'll stop making the PMI. Okay. So the type of loan that you have can determine how much PMI you make. Now, if you already have PMI, like I did, you can opt out of it by writing a letter to your lender or sending them an email, which is what I did. Once you reach 20% of equity in your home, or if you've made significant improvements in your home, you can opt to have your PMI removed. Now, if the property value of your home increases not related to improvements, then you can still opt to have PMI removed. Okay. Fannie Mae and Freddie Mac require you to have 20% equity. Okay. I just wanted to pull up my statement with you guys so you can see how much I was paying monthly in mortgage insurance payment. Okay. So looking back at 2022, even 2021, my mortgage insurance payment was $114.79 a month. So if you times that by 12 months, let me just see. That's $1,377.48 I was paying a year for PMI, for mortgage insurance. So I definitely wanted to remove that because that extra payment was no longer needed. I had reached the value of my home had increased and there was no need for me to pay this mortgage insurance any longer. So the my lender actually sent me a letter, and I'll go ahead and read that letter to you guys, just so you guys can see what they said. Your above referenced mortgage loan has private mortgage insurance. It protects lenders and others against financial loss when borrowers default on their mortgage obligations, which is what I already explained to you guys. Charges for PMI premiums are added to your monthly loan payments. You may be eligible to obtain a cancellation of your PMI requirement under certain circumstances or as required by applicable law. Unless cancellation is required by state law, the conditions for canceling PMI on your mortgage may be changed at any time since they're not statutory under federal law. Then they go under the criteria for canceling my PMI. Okay, so it says the borrower can request cancellation. So it says you have the right to request that PMI be canceled on the date that the principal balance of your loan reaches 70% of the original value of the property. Okay. The value of my property has increased tremendously, as opposed to the price that I previously purchased the house at. PMI will only be canceled on or after the date the 70% threshold is met. If I submit a written request of the cancellation, which is what I did, I have good payment history, which I do. I've never been late on any of my payments. Or you are current on your monthly payments as the date of your written request, which is also true. All of the above are true. I've never missed any payments. I've been current on all my payments, and I did submit a written request. Okay. It says we received the request and at your expense, evidence that the value of the property has not declined, which it hadn't, below its original value, and certification that there are no subordinate liens on the property. Again, these are all true. I have no liens on my property. I make monthly payments on time every month, never missed a payment. So everything was in the clear for me. Okay. I did have to abide by Fannie Mae guidelines. And for this, I did have to get an appraisal on the property because I have a multifamily. The cost for a multifamily appraisal was not cheap. It was $750. which is crazy because if it was a single family home, it was only $150, which is a huge jump. That's $600 difference. But I went ahead, I paid for the appraisal, and that was that. Okay. Um, so obviously my appraisal came back higher. I had did, some repairs on the home, some updates, things like that. Not a lot, to be honest. But the upkeep of the home was pretty much in good standards. Okay. So because of that, my appraisal came back higher. Then they sent me another letter in the mail that showed me that now I do have cancellation of my PMI. Okay. So it says, in accordance with the Homeowners Act, blah, 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 PMI is no longer required on your mortgage account. And I was so excited when I saw this. This insurance coverage has been either canceled at your request or automatically terminated, and no further premiums for PMI are due. Okay. You will receive a billing statement within the next 30 days with your new payment amount. Any collected or unremitted mortgage insurance payments in your escrow account will be taken into consideration at the time of your next escrow analysis. So this was a huge win for me, and I was so excited that I took care of this because $1,300 a year, it may not be a lot to some people, but it's a lot to me. So $114 a month decrease on my mortgage was a whole lot. Okay. So I'm very excited, and that's basically all I had to do. So you might have the question of um how do I remove PMI from my monthly mortgage? I will first contact your lender. Okay. If you have a conventional loan, of course, contact your lender and see what the necessary steps are. Okay. Some might need appraisal. Some might automatically cancel the PMI when you reach 20% equity in the property. But some of them might request that you still make a written request. Okay. I hope this video was helpful to you guys. If you do this and you have a conventional loan and you get the PMI removed, let me know in the comments. Or if you have any other questions about removing PMI, let me know in the comments. If this video was helpful to you, let me know in the comments. Thank you guys for watching, and I'll see you in the next video. Bye.